Welcome, I'm Josh O'Connell and this is Irish Tax Unwrapped. Whether you're a business owner, an investor, or just curious, we break down Ireland's tax code for everyone. In today's episode, I'm joined by my colleague Derek Andrews to talk about revenue inquiry and audit notifications. Hi Derek.
Hi Josh, nice to be here.
Let's start with the basics. What should someone do when they receive a notification from the Revenue Commissioners regarding an audit?
The first thing to note is that Revenue's Compliance Intervention Framework has 3 levels, levels 1, 2 and 3. Most people will be dealing with a level 2 intervention, which involves more serious investigations, such as risk reviews or audits. If you've received a level 2 notice, your priority should be determining whether you can make a qualifying disclosure and how long you have to submit it.
You just mentioned level 2 interventions. Could you explain what a level 2 intervention typically involves?
A level 2 intervention can take 2 forms, a risk review or an audit. Both are designed to assess tax compliance, but they differ slightly. A risk review is more focused and generally requires you to submit specific information within 28 days of receiving the notification. An audit, on the other hand, is more comprehensive, often involving a meeting with revenue officials and a review of your financial records.
How can a taxpayer determine if they are dealing with a risk review or an audit? And what are the key differences between them?
The notification letter will clarify whether you are subject to a risk review or an audit. For a risk review, the 28-day period is critical because that's the window during which you can submit a prompted qualifying disclosure. After those 28 days, you lose the ability to make that disclosure, even if the Revenue has not yet begun reviewing your documents. For an audit, you still have 28 days to prepare, but the actual audit process may be more drawn out, depending on when the auditor starts the examination of your records.
You've mentioned qualifying disclosure a few times. Could you explain what it is and why it's so important?
A qualifying disclosure is essentially a voluntary declaration where you admit to any tax liabilities that you may have overlooked. It must be made in writing, signed, and accompanied by the payment of any tax and interest owed. Making a qualifying disclosure can mitigate penalties, reduce interest charges, and crucially, prevent your name from being published on Revenue's defaulters list. It also protects you from prosecution, provided the disclosure meets all necessary criteria.
And Derek, what happens if a taxpayer needs more time to prepare their disclosure? Are extensions possible?
Yes, an extension is possible, but it must be requested in writing within 20 days of receiving the Level 2 intervention notification. Revenue may allow up to 60 days to prepare a disclosure. This can be particularly important if the taxpayer needs to conduct a thorough review to ensure they've identified all possible liabilities. In practice, we almost always request this additional time.
Okay, can we talk a little about penalties? How are they calculated, and what should taxpayers be aware of when making a disclosure?
But a disclosure doesn't require you to self-assess the penalty. It's advisable, though, to calculate the potential amount, as it will form part of the final settlement.
What happens if Revenue decides to expand the scope of the intervention? Can taxpayers still make a disclosure in that case?
Yes, if Revenue identifies further risks, they can extend the scope of the intervention to other tax periods or tax heads. The taxpayer will be formally notified, and as long as the expanded review hasn't started yet, they can make a further unprompted qualifying disclosure for those additional periods or tax heads. This must be done, though, before the new intervention begins.
One of the concerns many taxpayers have is about being named on the Revenue's defaulters list. How does a qualifying disclosure affect this?
If a qualifying disclosure meets all the criteria, you avoid being named on the defaulters list. In addition to reduced penalties, this is a major relief for most businesses concerned about reputational damage. It's also important to note that if a disclosure is made correctly, it protects the taxpayer from prosecution. However, if the disclosure doesn't meet the necessary criteria, Revenue could still pursue prosecution, although this is rare.
Finally, what advice would you give to someone who has just received a Level 2 audit notification?
My advice is to act quickly. Understand the type of intervention, whether it's a risk review or an audit, and immediately assess whether you can make a qualifying disclosure. If needed, request an extension to allow for a thorough review, and above all, ensure that any disclosure is complete, accurate, and accompanied by the necessary payment. This can help mitigate penalties, avoid publication, and protect you from prosecution.
Thank you, Derek. That's useful. It's clear to me now that navigating a revenue audit requires attention to detail and swift action. That wraps up today's episode of Irish Tax Unwrapped. We hope you found the information helpful and a bit clearer as you navigate Ireland's tax landscape. Don't forget to subscribe, rate, and share the podcast if you enjoyed today's discussion. If you have any questions or topics you'd like us to cover, feel free to reach out. Until next time, keep your finances in check and your tax knowledge sharp.